global ratings agency S&P, which has raised India's GDP growth forecast for financial year 24-25 by 40 basis points to 6.8%, but is still lower than central bank and government's projection of 7%. Now, S&P expect India to grow at about 7.6% in financial year 24, which is again lower than what India is expected to grow as per our own domestic data. Now, the New York-based agency retained India's GDP growth projection, however, for financial year 26 as well as 27 to 7%. Now, S&P says that in domestic demand-led economies such as India, Japan, Australia, the impact of high interest rates and inflation on household spending has reduced sequential GDP growth in the second half of financial year 24, which will likely also play up in financial year 25. However, it says that India is likely to see rate cuts of up to 75 basis points in calendar year 24. So essentially raising India's financial year 25 growth forecast marginally, about 40 basis points, but still lower than what India is projecting at the moment. Krishna Kumar here with me in the studio. Krishna, this is a global ratings agency problem for that matter. They have consistently kept India's growth targets at a lower pace and then have revised them. But it's not just S&P. There are a lot of other global ratings agencies who seem to be underestimating India's growth projections.
Yeah, and to their own folly. The problem here is that India has been beating expectations quarter after quarter when it comes to its growth numbers. We saw what happened with the December quarter GDP figure, which came in excess of 8%, in excess of our own expectations of how well we were thinking of doing. So in that sense, and it's interesting that S&P Global will come out with something like this. What technically they've done is that they've upped their own predictions from 6.4% to 6.8%. So technically they have revised it upwards. So you can expect them to revise it further upwards, when the final GDP figures for the current financial year comes out, when we calculate that. What it also says while predicting this 6.8% upward revision is the fact that inflation is set to ease going forward to about 4.5%. That's which is a good sign. Again, you just spoke about how current account deficit is narrowing. There is fiscal deficit that's narrowing as well. So the signs are really good for India to actually put up a better than expected GDP figure. And in that sense, I always go with this adage that always under promise and over deliver. And that's what the Indian economy seems to be doing. Indian economy seems to be doing at this stage. So from its own assessment of India's situation, it has narrowed down on 4 economies: India, Indonesia, Vietnam, which are all going to be the strong growth driving, momentum driving economies for the world going forward, apart from Japan as well. So the signs are right for India. All I'm thinking of is that they're being really conservative by just restricting that number to 6.8%. Bear in mind, RBI's own figures are above 7%, and even RBI's own estimates were beaten by the GDP numbers that came out for the December quarter, which was in excess of 8%, which literally nobody expected. So I would say wait and watch when it comes to India's GDP figures, Shweta.
Absolutely. And this also begs a question on whether there'll be revision, not a revision. We'll of course have to wait and watch out for that. But global ratings agencies seem to be using the same yardstick that they are using for developed economies, developing economies like India, and economies that are likely to be on that development course in coming few years. That same yardstick doesn't seem to apply and doesn't seem to do justice to economies like India, with a lot of factors at play. And consistently on various indexes, from press freedom to India's happiness index to now GDP, it does look like that ratings agency globally are not getting their parameters right for developing economies.
All kinds of rating agencies, the agencies that are rating India's economic growth to India's happiness. All kinds of ratings are really underestimating the scale of what is going on right here in India. Yes, there is overall doom and gloom kind of a scenario across the world. European economies are not growing as fast as they would like to be. Even the US is not growing as fast as it would like to be. And of course, bear in mind, all these ratings agencies and ratings companies and outfits, they sit in the West. So I think the mood of their mood is affected by what is going on in their immediate surroundings. They're not able to see all the green shoots of happiness and green shoots of growth that are happening in Asia. Yes, they're aware of it. that the fact of the matter is that the growth going forward is going to be driven by economies in Asia. Let's not single out only India. Yes, of course, with over 1.4 billion people, India is going to be a huge, India will be the major driver of growth going forward. But it's not just India that we're talking about. In Asia, across the board, there is Vietnam, there is Indonesia, there is other economies also supporting this growth for the world. And this is not growth just for Asia. Asia, in a sense, driving the growth for the world, and India, in a sense, driving that growth for Asia as well. So that is a consensus that they seem to have come to. It's only a matter of arriving at the right numbers. It's a matter of arriving with better estimating, using better statistical models, using more transparent data possibly to arrive at the possibility and also to literally chart the course of growth for India from here. I think what is happening here is that the data that they're using and the statistical models that they're using are a little outdated. So they seem to be a little slow when it comes to predicting the rate and pace of growth that India can possibly put up.